Hello and welcome to the first part of a special two-part note in which we're going to be talking to one of the world's most famous emerging markets investors. It's now 25 years since the Templeton Emerging Markets Investment Trust opened for business. It has to be said, even by a jaundiced financial hack, that it's done very well over that period. So I'd now like to talk to the manager about how he has performed over those last 25 years. He is, of course, Mark Mobius. Mark, thank you very much for joining me today.
Thank you.
Let's start by taking a look at the Templeton Performance in context. This is what's happened over the last 25 years. We're looking at NAV rather than the share price here. Obviously, particularly over the period that started in about 2002, your performance has been very impressive. What, first of all, do you think has led the performance of emerging markets as a whole compared to the developed markets?
It's growth, economic growth. Although a lot of people say there's no relationship between economic growth and the stock market, there definitely is over the long term. Because if you have an economy that's growing at 5, 6, 7, 8%, companies in that economy are going to do quite well. Now, not all of them will be emerging market companies.
Right.
Some of them will be companies that are listed on the developed market exchanges. But there's definitely a relationship. And the whole idea of being in emerging markets is to capture that growth.
Okay, now how have you managed to outperform, given that you've been looking for that growth, how have you managed to outperform to the extent that you have, particularly starting in 2002? What were the critical decisions you've made there to
I think the critical decisions were very much in line with what John Templeton taught us way back when we started our very first fund in 1987. And that is, go where others fear to go, fear to tread, and do what other people are not doing. In other words, go to the unpopular places.
So that would have meant Brazil in '02, for example?
Exactly. Of course, do your homework, make sure that the companies in which you're invested are sound, with good management, but buy them when they are unpopular. I think that is the key. And hold them through thick and thin if you still believe in the management.
Okay, and how concentrated is your portfolio? It's generally the more stocks you have, the harder it is to outperform. Have you generally had a high conviction portfolio over this time?
Yes, very much so. We're very concentrated. You'll see a number of companies in the portfolio with over 5% of the portfolio holdings. So it's very concentrated. No more than 60, maybe 70 stocks. And as you know, it's a pretty big fund, so it's very concentrated.
And now let's take a look at the last few years. Obviously, the sentiment has turned against emerging markets as a whole over the last 3-4 years since the bounce back from the crisis. And Templeton appears to have had a particularly tough time of it over this last 2 or 3 years. Why have emerging markets turned down?
It was mainly because of the so-called tapering issue.
Last year.
You know, what happened prior to that is that fixed income investors went into emerging markets to buy emerging market bonds because Moody's, S&P, and all the rating agencies were upgrading these countries because the debt to GDP ratios were low, foreign exchange reserves were up, growth was good. Then when tapering talk started, everybody exited. Of course, currencies went down, and people in equities got frightened. So emerging markets underperformed.
Okay, so your emerging markets haven't emerged to the extent that they're not prone to those kinds of capital flight issues that they've had on several occasions during the last 25 years then?
Now we have a global market. When you have this massive movement of money from one country to another, you're bound to have an after effect on the equity markets, and that's exactly what's happened.
And how have you at Templeton been playing this the last few years?
What we've done is we've looked at individual stocks to see how the currency impacted these stocks. For example, India, the rupee depreciated massively, but Tata Consultancy did very well in dollar terms because they were receiving their income in dollars, but their cost was in rupee. So that's the kind of selection we try to make.
Okay, Mark, thank you very much indeed.
Thank you.
That concludes our first part. Come back next time when we're going to be discussing what might work in the emerging markets in the next 25 years.